The beep of the scanner echoes off the glass counter. It is a sound heard millions of times a day. The clerk pushes the screen. The customer taps their phone, and the light blinks green. A routine exchange, a simple purchase. But the moment the data leaves the store, the story changes. While the clerk sees a standard payment, the reality is a bypass of the entire banking architecture. The money does not pass through the traditional rails of established institutions. It does not wait for clearing houses or overnight batch processing. Behind the glow of the phone screen, the transaction vanishes into a decentralized ledger. It is a silent migration of value. What looks like a retail purchase is actually a test of a new, invisible infrastructure. The old systems of credit and settlement are being bypassed in real time, one data packet at a time. This is not a glitch in the system. It is the system being rewritten. The world of finance is shifting beneath the surface, and the transition is already complete before the receipt even prints. The scope of this migration is not measured in single purchases, but in massive, constant streams of capital. Last month alone, stablecoins moved $74 billion in volume. That is not a small-scale trial. That is not a corporate pilot program testing the waters. It is a fundamental shift in how value travels across the globe. This represents the new plumbing of the entire financial system. Engineers and architects of modern ledger technology are no longer theorizing. They are actively rerouting the flow of money. We are witnessing a $6 trillion reboot of the credit card infrastructure, moving in silence. Where traditional networks once held absolute power over settlement, these decentralized protocols are proving faster, leaner, and more resilient. The sheer scale of the $74 billion proves that this is no longer a fringe movement. It is a massive, operational reality. The architecture of finance is being dismantled and rebuilt in real time, shifting the weight of the global economy onto digital foundations that never close, never sleep, and never pause for the banking day to end. Consider the traveler's check. It was a physical solution to a massive problem: how to move value across a map without carrying gold in a chest. It functioned as a bridge between the necessity of trust and the reality of geography. When a person stepped across a border, the check carried the weight of the issuing institution, ensuring that value remained intact even when the holder was thousands of miles from home. It was the gold standard for global movement in a fragmented world. Today, the geography of money has changed, but the problem remains. Stablecoins are performing the exact same function for the digital age. They act as a bridge that ignores the lines drawn on a map. By creating a form of money that is geopolitically neutral, these digital assets strip away the friction of national boundaries. They do not require a central authority in every jurisdiction to validate the transfer of value. They exist as a universal language of exchange, moving through the ether with the same reliable portability that once defined the paper check. The medium has shifted from ink on-site verification to cryptographic certainty, yet the core mission stands firm: to ensure value flows wherever it is needed, regardless of where the sender or receiver stands on the globe. The friction of the old world is measured in clocks and calendars. Traditional banking networks rely on legacy systems that require days to settle a single transaction. Money moves through a labyrinth of intermediaries, each layer taking its time to verify, clear, and confirm the movement of funds. It is a process designed for a slower era, anchored by the limitations of physical offices and banking hours that define when value can finally arrive. In direct contrast, stablecoin networks operate on a different frequency. Settlement happens in seconds on the blockchain. There is no waiting for a clearinghouse to open its doors. There is no pause for the weekend or the holiday. Every transaction is verified by code and finalized in the time it takes for a signal to cross the network. This mechanical superiority is the engine driving the migration of capital. Businesses are finding that the cost of waiting is too high in a global market that never stops. By choosing digital ledgers over traditional rails, they are opting for a system that rewards speed and eliminates the dead time of legacy banking. The choice is simple: wait for the old system to process the request, or use a protocol that completes the transfer before the screen even refreshes. The efficiency gap has become an unbridgeable divide. Corporate entities are no longer sitting in the waiting room of global finance. They have stopped asking for permission to build the future. Across the global market, companies are quietly rewriting their core operations, bypassing the slow crawl of regulatory approval. They're not waiting for a green light from central authorities. Instead, they are deploying their own digital infrastructure directly on top of existing decentralized ledgers. This is a deliberate, structural pivot. By embedding their value transfer systems into these protocols, they are effectively building a parallel financial network that exists outside the traditional gatekeepers. Every deployment of a smart contract or a liquidity pool is a brick in this new foundation. These firms recognize that the cost of compliance with legacy systems often outweighs the speed of innovation. So, they choose to move first and adapt later. They are creating their own rules, their own protocols, and their own pathways for moving capital. This is not a pilot project or a research experiment. It is a calculated, proactive takeover of the plumbing of global commerce. They are constructing a system that is designed to operate regardless of whether the old world understands it or approves of it. The architecture of the future is being laid down in real time, and it is being built by those who are tired of waiting for the status quo to catch up. Yet, beneath this rapid expansion lies a profound and dangerous absence. These decentralized systems exist entirely outside the reach of the Federal Deposit Insurance Corporation. There is no government safety net to catch the deposits when the code encounters a fatal error. If a stablecoin issuer fails, the capital does not simply pause, it vanishes. There is no bankruptcy court to facilitate an orderly recovery. No insurance policy covers the loss. The user is left with nothing but a digital receipt for an asset that no longer holds value. This is the reality of the new frontier. It is a system built on trust in algorithms rather than investors and businesses are now forced to weigh the convenience of instant settlement against the terrifying prospect of total loss. They are running a calculation every time they move millions through these rails. Is the speed worth the risk of a total collapse? The volume continues to climb, suggesting that for many, the answer is a reckless yes. They are trading the security of a government-backed vault for the efficiency of an unshielded network. It is a gamble of historic proportions, played out in the hidden corners of the global ledger where no regulator can intervene, and no backup plan exists to save the accounts if the system breaks. A silent migration is now underway, carving deep channels away from the legacy credit card rails. Trillions in capital are voting with their speed, moving into decentralized networks. Every second, massive volumes of value bypass the traditional clearinghouses. The old pipes are not breaking with a bang, they are being drained. The credit card infrastructure, once the bedrock of global retail, is becoming a hollow shell. Transactions that used to rely on central processing hubs now flow through digital ledgers, invisible to the banks that once held the keys. This is a structural exodus. Large firms are rerouting their cash flows, treating the old networks as legacy relics rather than essential conduits. The data packets that represent billions in value are simply turning away from the conventional gatekeepers. As this migration accelerates, the traditional rails are left holding smaller, slower, and more expensive traffic. The vitality of the financial system is leaking out, redirected into a faster, borderless architecture. It is a slow-motion collapse of institutional dominance, hidden in plain sight. The shift is not merely about convenience anymore. It is about an entire ecosystem choosing to abandon the old world for the efficiency of the new. The core of the old financial plumbing is being left behind, left to rust, while the actual movement of money finds a new, decentralized home. The era of the bank, as the supreme arbiter of value, is ending. For decades, the gatekeepers sat at the center of every transaction, verifying, clearing, and taxing the flow of money. That authority is dissolving now. Vast sums transfer across decentralized ledgers without ever touching a bank vault or triggering a legacy audit. The intermediaries are being bypassed, rendered obsolete by the sheer efficiency of peer-to-peer settlement. $1 billion in value can move across the globe in seconds, leaving no footprint in the traditional institutional logs. The banks have lost their visibility. They are no longer the essential conduits. They're becoming peripheral observers of a system they no longer control. This is not a gradual change in policy. It is a fundamental dismantling of institutional power. The code now dictates the terms of settlement, and the ledger provides the only source of truth. Every transaction that bypasses the legacy network is a vote of no confidence in the old guard. The gatekeepers remain at their posts, but the gates have been removed. The flow of global value has found a new path, one that requires no permission, no middleman, and no institutional blessing. The monopoly on value transfer is broken, and the power that once rested in the hands of the few is being redistributed into the decentralized architecture of the digital age. The $6 trillion shift has hit a breaking point. Velocity is no longer a metric of success. It is a force of destruction. As the total volume of decentralized value transfer surges, the pressure on legacy systems intensifies to the point of structural failure. The old guard stands at a precipice. They have two options: radically adapt their entire internal architecture to integrate this new reality, or face a total and irreversible systemic collapse. There is no middle ground remaining. The inefficiency of the past is being exposed by the relentless, real-time pace of the digital ledger. Every second that passes without transition widens the gap between the surviving networks and the obsolete ones. Boards of directors and central planners are forced to witness the erosion of their relevance. They are not merely losing market share, they are losing the very foundation of their existence. The ultimatum is written in the data. Evolve the core protocols to match the speed of the blockchain, or be permanently archived as a relic of a slower, closed-off era. The infrastructure is screaming under the weight of its own inertia. The choice is binary. The clock for traditional finance has stopped ticking, and the era of forced evolution has begun. If they do not pivot now, they will simply cease to function. The transition is not a headline. It is not a sudden crash or a loud declaration of war. It is happening in the quiet, consistent stream of data packets moving across a decentralized network. Each transaction is a stroke of a pen, carving a new path for global finance, while the old ledgers gather dust. We are living through the final chapters of a system that once defined the physical world, watching as the ink dries on a new digital architecture. The scale of this shift is not just measured in trillions of dollars, but in the fundamental way we assign value across borders. There is no going back to the era of paper receipts and 3-day settlement windows. That world has been replaced by the absolute, immutable record of the chain. This is a permanent historical transition, a silent migration of power that has already reached its point of no return. The old world of finance is being rewritten, one block at a time, hidden within the complex, invisible threads of the code. We are witnessing the end of an age and the birth of a new, borderless reality. The ink is no longer in the vault. It is in the network, and the story of global finance will never be the same again.